It's been kind of a crazy week for you, I think. You know, you get up one morning to, plan the final plan for the decision on Wednesday. There's an outbreak of cases that night. You guys get up in the morning and sit down and realize we can't do the rate hike now, even though labor market demand, everything warrants it. Does this mean now that you can't move ahead with rate hikes, as you signaled you probably will, until the cases are back under control?
I don't think so. I mean, when would that be? We have to focus very much on our purpose, which is, of course, the inflation and employment mandate that we have. And, absolutely this week was not the best timing to be looking to reduce interest rates, given reduce the monetary stimulus, I should say, given the health situation. But, time is on our hand. We can observe what is going on, and the underlying economics remains the same. We have significant capacity constraints. We have one-off price spikes. We have rolling supply disruption creating the costs. We are above maximum sustainable employment. So the underlying situation remains the same. But we thought best, let's just observe over the next few days at little cost to us.
Well, you brought up an interesting concept, I thought, at the press conference a couple of days ago when you talked about a strategy of permanent flexibility, the need for the central bank to manage its way through a virus environment, knowing it's going to come and go. Does that mean that you could potentially hike the key rate, maybe even in October, even if there's still instances here and there of outbreaks and targeted lockdowns?
I think it does. I mean, the real issue is at what extent is monetary policy being useful. I mean, the single largest lesson we've had globally is that it's government fiscal policy that is most impactful to manage this type of crisis. It's a structural crisis. It's not a cyclical behaviour. We've seen government step in and bolster household balance sheets, business balance sheets incredibly effectively. And so that puts monetary policy in a useful but very secondary role. And we need to just be true to our mandate, which is to say, are inflation pressures rising? Are we at or above maximum sustainable employment? And hence, should we be back more at a neutral interest rate? What would change that view? Well, you would have to see a significant shock to demand. What we've learnt through time is that incomes remain strong, demand bounces back very quickly, and that these rolling lockdowns will continue for a while. So that flexibility, remain focused on the medium-term target.
Well, I hope all those investors and traders who kind of control the market expectations for rate changes are listening closely, because market expectations for an October hike, which had been much, much higher, maybe close to 100, are down to 59%. Maybe that's, first of all, because you skipped this rate hike in the midst of that sudden lockdown in New Zealand because of this surge outbreak, or the case outbreak, but also maybe because it's not going to be a monetary policy statement meeting where you typically would make a rate change. It's a monetary policy review meeting. Now, it's true, you announced the end of your long-term security asset purchases at a meeting just like that. But are you then saying that October is a live meeting regardless of any of this?
Of course, October is a live meeting. We retain the right, but not the obligation to move policy when we think it's necessary. We can communicate in many different ways. Our monetary policy statement released this week outlines very clearly our views on what the neutral interest rate is, where we see the capacity pressures, how we see inflation performing. And, we have the official cash rate back at neutral over next year, the course of next year, which is 2% compared to 0.25 now. What would push us off that course? We would have to be very convinced that the supply side has suddenly been able to respond, removing inflation pressures, or the demand side for the economy has had a significant turnaround. And that would mean fiscal policy is not doing its job.
Governor, looking through to July next year, you can actually see the rates markets are pricing in just over 100 basis points of hikes from the RBNZ. Is that something that gives you confidence in terms of how potentially the recovery plays out? Or do you think, given the uncertainty of Delta, that's a pretty big bet to be making?
What all we can say is, to the best of the way we see the economy unfolding, how we see demand, which is the more certain side of things, given the role of fiscal policy, given the very strong situation of household and business balance sheets, given how we have seen consumption snap back post-lockdowns. Demand is fine. Supply is being constrained. And when you're in that situation, that's inflationary. So, this is why we're saying we are comfortable the economy can maintain its momentum with less monetary stimulus. And you have to remember that 2% is neutral. That's 1.75% above where we are. So we're not putting the brakes on the economy. We are simply reducing the accelerator. Is it a big bet? I don't know.
How much pressure of the need to start normalising comes from the red-hot property market? This is, of course, something that the RBA is struggling with as well here in Australia. But I know you had this very pointed exchange with lawmakers yesterday. Do you feel that the heavy lifting still needs to be on the macro-pru side?
I think the heavy lifting needs to be on the supply of housing. We can muck around on the edges of aggregate demand. Financial stability measures are very stable in New Zealand. The bank system is well capitalised. They are very diversified, their bank lending. So there's no financial stability issue. There's more of a housing supply issue here in New Zealand. And so, we need to focus on consumer price inflation, maximum sustainable employment, and we need to see a supply response. We are very confident that is coming. And what I've been saying yesterday is that house prices in New Zealand are not reflecting that very strong supply, the strongest impulse since the 1960s in New Zealand, construction activity at record highs. We say that house prices are unsustainable at their current level, given where demand is constrained, supply is growing. We see a correction happening, not because of macro-prudential tools, but because of underlying economic fundamentals.
Governor Orr, a lot of people were saying, you just said we're in an inflationary situation. Is the economy in New Zealand overheating? Is there a risk of waiting or being deterred by lockdowns too many times?
I think there's a risk to both sides. And without doubt, the single worst thing that could happen for a central bank is to have inflation expectations become unanchored, to become, well north of the midpoint of our target band. To date, we have been very confident they are well anchored. They're anchored because the markets expect central banks to do their job. And so we need to have the confidence to do our job, to make sure that the value of our money is retained through time. And that's what we'll be doing with interest rates. The challenge is the monetary and fiscal policy coordination. We know now we are in a good situation with the government.